Hey everyone, Mortgage Nerd here. I want to talk to you today about mortgage insurance. Sometimes it's MIP if it's FHA, that's mortgage insurance premium. Sometimes it's PMI, which is private mortgage insurance. What's the big deal with mortgage insurance? People hate it. People say it's like throwing money away. Why am I going to spend mortgage insurance? No, I'll put more money down. Well, let's break it down. Let's use two examples of mine from last year, from 2020. One is a property that I purchased for my mother-in-law. The other one is a property that I have that's now my second home that I refinanced to get out of my VA mortgage and get my new property into a VA mortgage. And when I financed, I went up to 90% on that property. I cashed out. So anything over 80%, you have to pay mortgage insurance, PMI in this case, because we didn't do FHA. On my mother-in-law's property, we bought that at 207. We only put 5% down because it just didn't make sense for me to put 10% or 20% down on that property. 5% was great with this mortgage insurance. Let's look at these numbers. Make a little room here for the numbers. $500,000 value on a single family home. We did 90% loan to value. So that's the same as putting 10% down. That means if I put 20% down, or if I had a 80% loan to value, that's a $400,000 mortgage, right? So 500 value, 400,000 mortgage, I would have no MIP or PMI. Well, I didn't want that. I wanted a 500 value with a $450,000 mortgage. That's 90%. So the 10% difference, that $50,000, I kept it. I didn't have to put it down or pay down my mortgage to that amount. And so what did it give me? It gave me a $140 per month payment of mortgage insurance. Let's really break that down. $140 per month equals $1,680 per year. $1,680 per year. What does that mean? Well, let's look at it this way. That $50,000, if I put it in the bank, put it to invest somewhere, and I made 6% after taxes, and I made $3,000 a year on that $50,000. But I paid $1,680 in mortgage insurance. So that makes sense to do that, right? Well, what about 3%? So that's $1,500 a year, as opposed to paying $1,680 in mortgage insurance. Now, I think you should talk to your accountant or your CPA to find out if your mortgage insurance is tax deductible. I think it is, especially if it's on your primary residence. But hey, check with them. Maybe in your case, it doesn't matter. It made sense to me to have that mortgage insurance and not pay down the balance, especially if you're investing in, crypto where you're making way more than 6%, or you invested last year in just the S&P that was making double digits a lot of last year. Now let's look at the $207,000 property where I put 5% down. So that's $99 a month. We're going to average it to $100 a month of mortgage insurance. It's $1,200 a year. And if we save $31,000, 15% of 207, 15% of 207,000 is $31,000. It's $31,050. We'll just say $31,000. 6% of $31,000 is $1,863 a year. So it's not as good a deal as on the other property, and that's mainly because it's 15% over the 80%. It's a 95% loan to value, while the other property was a 90% loan to value. So there you see how my mortgage insurance could have been less on the investment property or my mother-in-law's property. It's not an investment property. That's a little trick, by the way. You can buy a property for someone else, for your kids, for your in-laws, for whoever. They're the primary buyer, and you can have that as, like me, a non-occupying co-borrower. It's a long-term investment for me. So anyway, I'll make a whole nother video on that. But here you can see, is mortgage insurance really worth it? Is it a waste of money? Are you going to put your money to better use somewhere else? I think so. I would rather have my money work for me in other areas and pay small amounts like mortgage insurance, or pay a smaller interest. Now, this is not factoring in the mortgage interest that's paid. So if you're paying 3% on top of the mortgage insurance on that money, think about that too. So maybe we're getting to that 6% range. But how do we get rid of mortgage insurance? This is a whole nother topic, but it's an important one to understand, because Values have gone up tremendously. These properties that I financed were a year ago. Right now we're in August, and this was last July and September respectively. So the values have gone up a lot. I went back to the servicer, because I'm not the servicer, I don't hold the loans, I sell the loans. Went back to the servicer and asked them, okay, well, what do we do to get rid of this mortgage insurance? Option one, without refinancing, is you wait 2 years after the loan started, then you can request an appraisal, and then if it's under the 80% loan to value, we get rid of it. Beautiful. This was perfect. My money's making money somewhere else. I get rid of mortgage insurance. Now it's like free. I'm not having that extra payment on it. Just the regular interest, whatever it is, 2.25, 2.75, 3.25, wherever your rate is. The other option is you refinance the property. Problem there is you will incur more closing costs. So it's not always advisable. It's really case by case for you to look at and see if it's worth it to you. But that's my take on mortgage insurance, the big bag, evil mortgage insurance. I don't think it's that bad, really. For some people, it still is. I have a friend who's putting over 50% down on a property and wants to pay it off fast. I'm like, come on, man, you're talking a rate that's in the twos. It's in pace with inflation. It's like you're going to lose money if you do that, but he doesn't care. He wants his debt out of the way, and that's fine too. I'm not trying to impose my beliefs and my risk tolerances on anyone else, but I'm just educating you on the value of money and some of the better uses of it. Mortgage Nerd out. Thanks.